Happy New Year and welcome back to another edition of Lipper's Fund Flows Insight. My name is Tom Roseen. Thanks for joining me today. I'll be reporting flows for the weekend of January 4th, 2017. I don't think anybody will be really surprised that we saw outflows this week. This is I saw outflows about $15.9 billion from the conventional fund business. We'll talk about ETFs as well later on, but there's from the conventional fund business. I don't think anybody will be surprised that investors were really sitting on their hands, just kind of waiting to see what was happening. Year end, long weekend. We had a holiday weekend, so it was going to be 4 trading days, and we've really had some pretty good rallying going on all the way up to last week. And in the last week, we saw the first decline in 7. As far as run of weeks as far as performance goes. So it really was just time to take a breather. Investors actually heard some good news. Basically, they saw that the last week's the jobless claims actually declined, and then also they saw new car sales pop up. But again, they were just hesitant to make any commitment before the year end, and kind of waited to see what employment figures were going to do and come out today. So basically, that brought us to what we're doing as far as the flow weeks go. Let's go ahead and take a look at our macro groups and see how that panned out. Basically, we saw equity funds lose about $5.5 billion. We saw taxable bond funds take in a little bit of money, a little bit over $100 million. And then we saw muni bond funds, again, take it on the chin, $1.5 billion this week. And, of course, the money market funds has kind of been wishy-washy, about $9 billion in outflows. Let me say, though, that we had gotten calls for the prior 2 weeks, right before Christmas and then also New Year's, about big flows that we saw. And they were just kind of really monstrous flows, and we found out that there was a reason to this. It was basically distributions that caused a lot of these headaches. What it is the fund went ex-dividend, a group of funds went ex-dividend on Wednesday. So the NAV dropped by that amount. It went into their coffers, and then the funds reinvested it the next day on a Thursday, and that's why we saw big outflows. Well, the follow-up week, we actually saw those as inflows, so we really had a timing issue with some of these big numbers. We just wanted to put that out to folks that it really was a timing issue. We didn't really see the big outflows in the last 2 weeks, or the last 2 weeks of the year. Really, it was just a timing issue for distributions. Well, let's go ahead and take a look at what happened in the equity funds and give you more detail of what happened this week. Basically, we saw 1.50% return, pretty strong. Second week in 3 that we've seen positive returns. But we saw $5.5 billion in outflows, and this is where I talk about it. Basically, we saw the 42nd week and 43 of outflows, but really, because that anomaly that we saw in the week before, really it's the 43rd consecutive week of outflows. Again, it's just an anomaly what those happened. If we were really looking at the true outflows, it was the 43rd consecutive week of outflows. Domestic equity funds suffered their 48th consecutive week of outflows. Again, the anomaly in there. $4.3 billion came out of their coffers, and if we take a look, and by the way, they had a 1.29% return, wow, head scratcher. Non-domestic equity funds also saw outflows about $2.8 billion, and this is the 6th week in 7 that they saw outflows. Now, if we break this down, we saw large cap funds actually lose the lion's share. It's been an ongoing story week after week after week. This week it was $3.2 billion, and on the world equity side, we saw about $0.7 billion leave the international market, and we saw about $0.6 billion leave the global market. So that's how that kind of panned out. Let's see how, though, the flows differed on the ETF side. For the 12th week in 13, we saw inflows, this time to the tune of $7.9 billion. At the top of the group, as we might expect, in a week that's actually doing good in performance, ETF investors are a little more nimble than the average mutual fund investor. We saw Spider, S&P 500, take in about $3.1 billion. iShares, Russell 2000, has been an ongoing story for the last several weeks, taking about $0.8 billion. But on the bottom side, we saw the PowerShares QQQ Trust 1 lose about $1 billion, and Spider Gold lose about $355 million. So that's been kind of the story that's been going on with the ETFs and the traditional mutual funds. Again, a continuation of the tale of two cities. Again, I've broken that idiom over and over again, but this certainly was a continuation of that story. Let's see how it panned out as far as fixed income universe goes. There was a little bit of difference there as well. We saw for the first week in 4 inflows, only to about a tune of about $114 million. It's the 3rd consecutive week, though, we've seen plus side returns 0.63%. And this is one of those stories where people people are going to keep an eye on it. Obviously we had the Fed, bump its interest rates up. We had the first increase, 25 basis points, middle of December, and then investors started getting a little bit nervous with where the market's going, and also what the Fed kind of was saying after it, that they're going to have three more bumps in the cards in 2017, and maybe even an accelerated schedule for that. But again, investors were more concerned and more focused on some of the problems that are going on in the market, and they decided to go back into fixed income funds. Here's how it broke out. Basically, corporate investment grade debt funds took in $1.4 billion, fourth consecutive week they've taken in money. Loan participation funds, a subset of corporate investment grade, took in 468, almost $500 million of that. And then when we see on the bottom of it, we of course saw the government mortgage funds losing about $0.9 billion. So people were getting out of the way of government and treasury related issues. Now if we take a look at ETFs, we do see a similar pattern but to a larger magnitude. Basically ETFs, fixed income funds, took in about $1.1 billion, second consecutive week they've seen inflows. And at the top, as we've seen lately, we saw the Spider Barclays High Yield Bond Fund taking about $220 million, and iShares iBox High Yield Corp basically taking in $208 million. So we see that, and also we see loan participation funds at the top of there. On the bottom side, as we'd expect, or as with the bump in interest rates, the iShares 20 plus Treasury ETF lost about $239 million, and of course we saw kind of a group of treasuries at the bottom, as we'd expect. Now we take a look at munis, and they certainly got the 1-2 punch again. About $1.5 billion exited their coffers. Eighth consecutive week they've lost money. Second consecutive week, however, they've had plus side returns, this time to the tune of 0.44%. Not too shabby, consider a weekly return. National munis obviously saw the largest outflows as they have been for the last several weeks. $1.2 billion, again, eighth consecutive week that they've seen outflows as well. Brings us to our last category, and that's money market funds. Money market funds for the third week in four basically saw outflows, this time to the tune of $9 billion. And how it broke out, if we took a look at it, taxable money market funds saw about $9.6 billion in outflows. And when we break that down even further, institutional money market funds saw $12.6 billion, while the retail money market funds saw about $3 billion in inflows. And when we take a look at tax-exempt money, obviously, people are starting to think about Uncle Sam and paying taxes. We actually saw about $601 million enter the tax-exempt money market fund group for the total flows that we just talked about. Well, that brings us to the end of this conversation, but really we're going to keep an eye on what the markets are doing. Midday today, we actually were in Denver, Colorado, so early this morning actually, we saw that the non-farm payrolls came in. They actually came in a little bit lower than expected. I think most people were expecting about 180,000, and we came in about 156. So that was actually kind of good as far as inflationary concerns and the Fed increasing the magnitude and the frequency of the rate increases. But one alarming piece that was in there and a lot of people didn't pay attention to, we saw a 0.4% increase in wage growth. Highest in 7 years, and actually wage inflation is what people got to keep an eye on. Once we start getting wage inflation, that's a good portion of what inflation is going to be concerning, and we certainly could get the Fed responding. We won't know obviously for the next several weeks, maybe even months, but certainly we might get some impact next week as well. Well, that's it for me. If you have a need to do a deeper dive, you can go to our site at www.lipperusfundflows.com. If not, join us next week where one of our analysts will talk about the flows of the week. Thanks for joining me. My name is Tom Roseen, wishing you the best in your wealth planning and creation.